So thank you. First of all, it's a great honor to be here and to present on this panel. So I'd like to thank the Central Bank of Chile and, of course, everyone who organized the conference for the invitation and for making this possible. So I'd like to talk a little bit about fintech from the perspective of financial stability. I'm from the Financial Stability Board, which many of you know is an organization that brings together central banks, ministries of finance, regulators from around the world, from the G20 countries and a few, and has been working on fintech for several years now in the context of regular monitoring of financial innovation. But then also has issued a few public reports on this, including a report to the G20 that Daniel mentioned earlier on, and a few monitoring reports on issues like fintech credit that was joint with the Committee on the Global Financial System, and recently on artificial intelligence and machine learning. So I'd like to talk a little bit about some of the insights from that. I'd like to talk about kind of the trajectory of market developments in fintech recently. And I think the key point that I'd like to make is that, as was mentioned before, we look at these fintech innovations from the perspective of the economic functions behind them. And technology changes, but the economic functions themselves do not. So finance remains finance. Finance can be a very powerful driver of growth and welfare. We know this from past centuries. Finance is the backbone of a healthy economy. But when the financial system is impaired, this can be very damaging for growth and welfare. We saw this in the recent global financial crisis and in financial crises before. So looking at things from a financial stability perspective is very important, and the FSB, when you look at things given our mandate, it's squarely from that perspective. So recently, a number of things have been happening in fintech. We've heard about some of them before, and we've also heard the definition of fintech. The FSB also has a definition, which is actually similar to the one that Jon mentioned. So the FSB definition is technology-enabled innovation in financial services that could result in new business models, applications, processes, or products with an associated material effect on the provision of financial services. So this definition means that fintech cuts across the spectrum of functions. So there's lending, credit intermediation, peer-to-peer marketplace lending, but also robo-advice, insurance, and also I'd like to add in the area of regulation and supervision, and there's RegTech, so applications to improve regulatory compliance by financial institutions, and also SupTech, the term used for technologies used by the regulators and supervisors themselves to improve regulatory and supervisory effectiveness. So since, in the past year or so, we're seeing a couple of shifts in the market. So in fintech credit, for example, it's been notable that the growth rates have been very fast. We're seeing, in absolute terms, China is the largest market for fintech credit provision, followed by the United States and the United Kingdom. In Latin America, of course, we've heard that Brazil, Mexico, Chile, and Colombia are very important markets. What we have seen, though, in the past year or so is that a lot of platforms have not been profitable. There have been some rising loan losses, and this depends a bit on the market. In other markets, we're continuing to see very quick growth rates. But I'll come back to some of these issues in just a minute. In the area of distributed ledger technology, there are a lot of potential applications for securities clearing and settlement. There are discussions of central bank digital currencies. These are all very interesting. I just note that on DLT, a lot of things are still in the experimentation phase, so there's a lot of potential, but a lot of things have not yet been rolled out. One of the big areas is the application of artificial intelligence and machine learning across finance. So AI can be used for all sorts of things, for automating customer interaction. We heard about chatbots, for credit scoring, for insurance pricing. There are also a number of back office applications, so automating certain regular processes in financial institutions, for trading, trading execution and portfolio management, and then finally for RegTech and SupTech. So there's really a lot going on. This could be a very far-reaching technology that's already being applied, I think, to a greater extent perhaps than DLT, and really could be transformative in a number of ways. And finally, in the competitive landscape, we're seeing some shifts as well. So first of all, there's a trend that fintech startups, rather than trying to challenge financial institutions, are often partnering with financial institutions. So this is a very notable trend. I think what Jamie was describing is perhaps indicative of some of the trends in the market as a whole. But one of the other big trends is, of course, the entrance of technology firms into financial services, the tech fins that we heard about before. So I'll talk a little bit about financial functions, and in the report to the G20, we talked about the frictions in finance that are inherent from an economic theory perspective, market failures. So there are a few of them, and these remain even with new technologies. So for lending, for example, we know that lending involves ex-ante and ex-post moral hazard and information asymmetries. So a bank's job is to screen potential borrowers. So both ex-ante to find the good risks, but also ex-post to ensure repayment and to ensure credit quality. And this is a difficult process, something that banks specialize in. It takes a lot of information. And of course, new forms of information for credit scoring can be very powerful and very helpful. But I think that some of the same issues here with proper screening are there. And if you're using new data sources that don't go back very far, that you only have a few years of historical data on, then there is a potential issue that you don't have a full credit cycle. If you're using 7 years of historical data, but you're missing 2007 and the global financial crisis, then this is really problematic. So I think that with fintech credit platforms, as we've said in the report with the CGFS, it's very important to keep these things in mind and to test these things over a full credit cycle. This will mean kind of ongoing maturity and development. As another example, insurance. So we've talked a little bit about insurance. And clearly with big data, with the Internet of Things, there are some very clear examples of how information can be processed more efficiently. So we can better price risk. You can have a more fine distinction between different consumers and businesses. You can have insurance, of course, on demand for a short period of time or for very specific things. But there's another issue with this that our colleagues at the International Association of Insurance Supervisors have brought up in one of their public reports, which is that this also means potentially a breakdown in some of the risk pooling function of insurance. So at the moment, insurance also helps to pool risks among consumers. Think of health insurance. If we have a more fine distinction between potential risks of consumers based on future illness and the like, this could undermine some of the function that's currently there. This is essentially a societal discussion of what level of risk pooling we actually want through the insurance markets. So these are some of the risks, and there are others that are mentioned in the reports, but I'd like to maybe close on a bit more hopeful note, which is some of the opportunities from fintech, also from a public policy perspective and from a financial stability perspective. So certainly this will be the focus of the next session in financial inclusion. There are many opportunities there, and I'll just briefly mention what we've flagged in our report to the G20 is there are certainly opportunities for the remittances sector. So improving the efficiency of cross-border transactions could be very powerful, allowing remittances to be conducted more efficiently. One of the big issues in the remittances sector currently is, of course, that there's a lot of regulation around AML and CFT, so preventing fraud and money laundering. But with new technologies, there are a number of technologies out there that could help to identify these risks in a more efficient way. And by doing so, that could hopefully also reduce the costs of compliance, reduce the costs of remittances for consumers. And there are a number of other areas in financial inclusion that I think will be covered well in the next session. Another area that's more specific to financial stability is the greater diversity in the financial system. So if we look at credit provision, for example, I mentioned some of the risks, but there's also certainly the benefit that new credit providers could help to diversify the channels of credit to consumers and businesses, potentially using less maturity mismatch or leverage than other providers. And so having this diversity could actually be, could enhance stability, and that could be helpful. And finally, I'll talk about regulatory and supervisory effectiveness. So particularly in the area of AI and machine learning, we've seen some examples that are really interesting. So, for example, the Securities and Exchange Commission in the United States has spoken publicly, the staff spoken publicly about some of their experimentation with text analytics. So actually looking through regulatory filings for cues, for sentiment analysis, and this can help to better pinpoint some misconduct risks. So this is a very useful application of new technologies by the supervisor. Another example that we describe in our report is Banca d'Italia has used sentiment analysis from social media also toward financial institutions. So this can help identify risks. And they've also used similar applications for nowcasting, so for monetary policy purposes. And finally, an example is Quebec AMF. They've announced that they've used AI and machine learning techniques to improve the data quality of trade repositories. So for supervisors, this is a key issue, and here with new technologies, this issue of poor data quality reporting errors can be improved. And this is something that can ultimately improve supervisory regulatory effectiveness. So I think there are a number of opportunities out there. As we've said in the report, Daniel mentioned the currently no compelling risk to financial stability. I should add that there was a second half of that sentence which also said, but these could arise quickly. So we'll get back to these issues, I think, in the final session as well regarding the regulatory and supervisory issues. There are certainly quite a few, but one of the key ones is constant monitoring. So to continue monitoring the developments for macro financial risks. And we do so with private sector engagement, talking to private sector firms, talking to the public sector authorities that have their hands dirty, that are really in the field, and also to academic community that's able to look at these things from a kind of a neutral perspective. So with this, I'd like to pass over to Gabriele for the next remarks.